Welcome to this lecture on capital and land markets, where we'll unpack how factors of production shape value and allocation. Over the next slides, I'll guide you through scarcity, rent, capital dynamics, substitution, and real-world case studies, so you can see how theory maps to markets and policy in practical terms. This slide shows how finite supply meets insatiable wants to set equilibrium prices, with a supply-demand intersection determining market value for land and capital. Firms competitively bid for scarce productive resources, and downstream costs from coffee beans to cloud servers are shaped by those factor prices. Here we define land as nature-given resources that generate rent, driven by fertility, rarity, and geographic advantage. The diagram links soil, water, wind, minerals and location to rents, and shows how resource types renewable or non-renewable influence sectors like agriculture, energy, and real estate. This page contrasts downtown premium plots with lower rent outskirts and explains how land marginal productivity drives spatial allocation. As rents rise, firms substitute or optimize by adopting tech or relocating, guiding resources toward highest value uses, while also sparking debates about gentrification and displacement. Capital is presented as produced means of production, physical machinery funded by financial capital that creates direct output, while interest functions as compensation for time-bound productivity, balancing depreciation and investor expectations, and incentivizing innovation that sustains future productive capacity. Modern capital embodies human knowledge and technology, robotics, AI, and cloud servers boost the marginal product of labor, and firms face an investment trade-off: hire more workers or buy smarter machines, comparing marginal revenue products of each input against factor prices to optimize returns. Derived demand means factor markets respond to demand for final goods, illustrated by an e-commerce surge that increases demand for warehouse, land, and sorting robots. This shifts the market equilibrium, lifting rents and interest rates until new supply or substitution channels emerge to restore balance. Elasticity of substitution measures how nimbly firms adjust inputs when factor prices change. High elasticity examples like vertical farming and 3D printing show rapid adaptation and price responsiveness, while rigid input mixes trap sectors and amplify shocks, as seen in urban land shortages. The SpaceX case ties factors of production to market valuation, showing how remote coastal land, precision-built launch pads, entrepreneurship, and integrated systems create output value. The chart links anticipated launch frequency to rising Boca Chica land valuations, illustrating how expected future revenue capitalizes into current rents. Silicon Valley demonstrates capital land dynamics through bidding wars and the campus effect. Major firms bid up land prices reflecting high marginal productivity of clustered human capital, while lavish campuses attract talent and reinforce agglomeration, creating a self-reinforcing cycle of high value. This slide maps how rent and interest steer resources toward productive uses, and how policy interventions like zoning or interest rate changes ripple through product markets. Those levers can alter incentives, prompting innovation, conservation, or relocation depending on how scarcity and societal wants are balanced. Finally, factor market insights translate into strategic tools. Analysts can predict wage gaps, forecast real estate cycles, and anticipate tech investment waves, while entrepreneurs time land acquisitions and capital upgrades to capture marginal product spikes, unlocking competitive advantage and supporting sustainable growth.